Hello everyone, welcome back to the course related to goods and services tax. So in the previous videos, that is in module 1, we discussed about the introduction to goods and services tax, the characteristics of GST, the evolution of GST, the different taxes that were subsumed to GST, etc. So I hope all the basic details regarding GST is clear to you. So now today onwards we will be discussing on another concept which is important in the levy of tax in case of GST. So this module deals with the levy of tax, the composition scheme, the taxable person, time of supply, place of supply, value of supply, and the exemptions from tax. So in today's video, we will be discussing about the levy of tax, that is GST, and the composition scheme concept. So what do you mean by levy? Levy means in simple terms it is like a charge. It's a charge like tax, duty, fine, etc. It is levy means to charge. Okay. So in India, the power to levy taxes or the power to charge taxes lies with the Central Board of Indirect Taxes and Customs, that is CBIC in the case of indirect tax, and the Department of Income Tax, that is in the case of direct tax. So these two authorities have the power to levy tax in India. So under the GST Act 2017, levy is defined as on what income tax is levied. What is the income on which tax is charged? What are the exemptions to this rule? And what are the deductions? And what is the consequence of non-discharge of tax? That means if a person does not pay tax, what is the consequence related to that? So all these items, that means on what income tax is levied, the exemptions, the deductions and the consequence, all these things are defined in the GST Act of 2017. So basically the tax incidence, that means the burden of the tax payment is passed on to the final consumer or of goods and services in the case of indirect tax or GST. The details of income and the transactions are reported through periodical GST returns. Okay, so a particular transaction is beautifully explained in this introductory part. So let's see what are the provisions or what is the rule or what is in the case of this levy of tax. So when we talk about the levy of tax or charging of tax, one of the main concepts that should be kept in mind is the concept of reverse charge mechanism or RCM. So reverse charge mechanism, from the name itself, it is understood that this is something reverse than that is normally happening. So normally it is the supplier who collects the tax from the customer and remit it to the government. So in the previous introductory videos, we saw the calculation of CGST, SGST and IGST and how the tax amount is collected uh, by the supplier and how it is remitted to the government. So in normal cases, it is a supplier who collects the tax from the customer. The supplier charges a price that includes the tax amount from the customer and he remits it to the government. Okay. But in some cases, this mechanism is impossible. So in that cases, what happens is that it is not the supplier who collects the tax from the customer, but it is the recipient himself who remits the tax to the government. Okay, so I'll make it clear. In the case of reverse charge, the receiver becomes liable to pay the tax. That is, the chargeability gets reversed. So in the earlier cases, if I am a particular dealer and I am selling goods to you, so who is to I am the supplier here. I'm selling goods to you, and you are the recipient of the good. Who was liable to pay the tax, or who was liable to collect the tax and remit it to the government? I was the person. Okay. But in the case of reverse charge mechanism, this happens when you are liable to collect the tax and remit it to the government. That means you are the receiver and you becomes liable to pay the tax. That is, the chargeability is reversed here. Okay. So therefore, when a registered person, so this is reverse charge mechanism can be explained in three contexts. One of which is regarding the transaction between the registered person and an unregistered person. Okay, so if it is the case when a registered person purchases taxable goods or avails taxable services from unregistered person, the transaction is happening between a registered person and an unregistered person, then the supplier does not collect and remit the tax, but it is the recipient who is liable to pay tax on supplies. Okay, so I hope this concept is clear to you. So normally in normal cases, it is the supplier who collects the tax and remits it to the government. But in case of reverse charge mechanism, it is the receiver who becomes liable to pay the tax. Okay, so this is the normal comparison between the normal GST payment process and the GST payment in case of reverse charge mechanism. So from this picture, from this illustration, it is clear about the concept of reverse charge mechanism and the normal cases. Okay, so when is a reverse charge applicable? So I pointed out there are three or more cases or three or more situations where reverse charge mechanism is applicable. Okay, so one such situation is the supply from an unregistered dealer to a registered dealer. So let's see, when a registered person purchases taxable goods or avails taxable services from unregistered persons, the supplier does not collect and remit the tax, but GST is paid directly by the receiver to the government. So in this case, what happens is the transaction is happening between a registered dealer and an unregistered dealer, and here the registered dealer purchases goods from an unregistered dealer, and it is the registered dealer who becomes liable to pay the tax directly to the government. So registered dealer is the recipient here, or he is the receiver here. Okay, so he has to do self invoicing for the purchases made by him. Self invoicing, that is, invoicing is done by himself. So about self invoicing we will talk in the next class. Okay, so let's see an example here. So here we have an example. When a farmer sells his agricultural products to a dealer, the tax on supply cannot be collected and remitted by the supplier because farmer is an unregistered person. Okay, so here we have an unregistered person, that is the farmer, and a registered person. Suppose imagine that the registered person is you yourself. Okay, so the transaction happens between the farmer and you yourself. Here the farmer is an unregistered dealer and you are a registered dealer. Then in normal cases, it was a farmer or it was the person who supplies the product or who sells the good, uh, who was liable to pay the GST amount. But here, since this farmer is an unregistered person or unregistered supplier, it is the registered supplier or the purchaser or the recipient of the good who is liable to pay the tax to the government. Okay, so this is the first case, from an unregistered to a registered dealer. I hope you got an idea about it. Then the second case is regarding services through an e-commerce operator. So I hope you know what is an e-commerce operator. So RCM, which means reverse charge mechanism, is applicable to e-commerce operator who is liable to pay GST. So if he has no physical presence in the taxable territory, a person representing him will be liable to pay the tax. Okay, sometimes e-commerce operator will not be physically present in a place. So, in that case, a person who is representing him will be liable to pay the tax to the government. Okay, and if there is no such representative, then the operator would appoint one person who may be responsible, and that person will be liable to pay the tax. Okay, so RCM or reverse charge mechanism is applicable to the e-commerce operator. Okay, then let's see an example here. Urban Club provides services of plumbers, electricians, teachers, beauticians, etc. Urban Club is liable to pay GST and collect it from the customers instead of the registered service providers. Okay, so Urban Club uh, is an e-commerce operator who receives services from different registered service providers. They get electricians, they get the service of teachers, beauticians, etc. But Urban Club is the person who is liable to pay the tax, and they collect it from the customers. Okay. And the third case is the supply of certain goods and services specified by the CBAC, that is, certain particular type of goods and services which is already mentioned by the board. Um, that is, these goods or these products will come under the reverse charge mechanism concept. The products or the goods include cashew nuts, BD wrapper leaves, tobacco leaves, silk yarn, raw cotton, etc. There is a lengthy list of these certain goods and services specified by the Central Board of Indirect Taxes. Okay, so these are the main three situations where reverse charge mechanism is applicable. I hope you got an idea about it. Then now we come to the discussion regarding the composition scheme. Okay, so what is composition scheme, composite tax, composition levy? What does it mean? So, in case of GST, the large taxpayers or the large companies, they have all the facilities for complying with the GST formalities and the GST compliances, etc. But that is not in the case of the small taxpayers. Okay, so the small taxpayers get rid of GST formalities and they pay a or GST or a tax amount at a fixed rate of turnover under this composition scheme. Okay, so composition scheme is a particular arrangement, or it is a particular scheme opted by any taxpayer whose turnover is less than 1.5 crore rupees. Okay, so if my turnover is less than 1.5 crore, then what happens? I am able to opt for this composition scheme. Okay, so normally it is less than 1.5 crore, but in case of northeastern states and the Himachal Pradesh, the limit is now arranged to rupees 75 lakh. Okay, so a person or any taxpayer whose turnover is less than 1.5 cr can opt the composition scheme, where the small taxpayers they get rid of all the GST formalities and they can pay a GST amount at a fixed rate of their turnover. Okay, so in this case, the turnover means the turnover of all businesses registered with the same PAN. PAN is permanent account number. Okay. So turnover of all businesses registered with the same PAN should be taken into consideration to calculate the turnover. So under the same PAN, there may be more than one businesses registered. So if it is the case, all these businesses turnover will be taken while calculating turnover for composition scheme. Okay. Then a composition dealer can also supply services to an extent of 10% of turnover or rupees 5 lakhs, whichever is higher. So a person who has opted for this composition scheme or a composition dealer, he can also supply services to an extent of 10% of turnover, or rupees 5 lakh, whichever is higher. And this point is just for your understanding. So basically understand the concept of what is a composition scheme and who can opt for a composition scheme. Okay, so we discussed about who can opt for composition scheme. Who can opt? A person or a taxpayer who has a turnover of less than 1.5 crore can opt for composition scheme. So now the question comes as to who cannot opt for composition scheme. Let's see who all are the persons. The manufacturer of ice cream, then pan masala, tobacco, then a person making interstate supplies, then a casual taxable person or a non-resident taxable person, a businesses which supply goods through an e-commerce operator. These many people cannot opt for composition scheme. Okay, so keep in mind who are the persons who are um, able to opt for composition scheme, that is who can opt for composition scheme, and also who cannot opt for composition scheme. Then so now let's go through the conditions for availing composition scheme. Are there any conditions, or anybody who is below the turnover limit of 1.5 crore can opt for composition scheme or not? Is it only the restriction or is it only the mandatory thing? Okay, let's see. So the first condition is no input tax credit can be claimed by a dealer opting for composition scheme. So I hope you remember about the concept related to input tax credit, where we discussed about the concept of output tax and also input tax. So a person who is opting for composition scheme will not get input tax credit, and he cannot claim input tax credit. Okay. Then second condition, a person liable to pay tax under RCM has to comply with the normal GST provisions. So, if I am a person um, complying with the RCM, that is a reverse charge mechanism, and I am liable to pay tax under this reverse charge mechanism, so in that case I will not be able to avail composition scheme. Okay, so I will be able to I should be complying with the normal GST provisions. I cannot go for composition scheme. Then third one is it is only, that is composition scheme is only available for intra-state supplies, that is within the state, not between the states. Okay, then fourth, neither a casual taxable person nor a non-resident taxable person can avail composition scheme. So I hope you remember about casual taxable person, of which we discussed in the definitions part. So he carries on his transactions occasionally. Um, so a casual taxable person or a non-resident taxable person cannot avail composition scheme. Then, fifth condition, the goods held by him in stock on the appointed date must not be purchased from a place outside his state. That means it should not be interstate. So, what should be the goods? What should be the nature of the goods? The nature of the goods should not be classified as what is explained in the below points. Okay, the goods should not be interstate purchase, that is purchased from another state. It should not be imported goods, that is from another, it should not be from another country. Branch situated outside the state, the goods should not come from the branch of the business which is situated outside the state, and also it should not be supplied by any agents or principals situated outside the state. So in a nutshell we can summarize that the goods the goods held by the person should not come from another state. That means it should be only intra-state supplies. Okay, then we have the sixth condition is mandatory display of invoices of the words composition taxable person not eligible to collect tax on supplies. So, if a person is opting for composition scheme, these words, that is composition taxable person not eligible to collect tax on supplies, the words in this inverted commas should be displayed in his invoices. Okay, that is mandatory. And also mandatory display of the words composition taxable person on every notice and signboard displayed at a prominent place. So wherever the particular person, the taxable person, puts on a notice or a signboard, wherever it is displayed, whether it is in a prominent place, so that particular person needs to mention these words composition taxable person in that notice or signboard, which is a mandatory requirement. And last, he is not a manufacturer of such goods as may be notified by the government during the preceding financial year. So during every financial year, the government, or during every preceding financial year, the government will notify certain items or certain goods that should not be form part of a person who is opting for composition scheme. So that person should not be, the person opting for composition scheme should not be a manufacturer of these goods which are notified by the government in the preceding financial year. Okay, so these are the two concepts that we discussed in today's video. That is, one is regarding reverse charge mechanism, and second is regarding the composition scheme. So I hope you got a clear idea about what reverse charge mechanism is and what composition scheme is. In the next video, we will discuss about the place of supply, time of supply, and value of supply of goods, and how tax incidence falls, or what is the value of tax to be taken, or value of supply to be taken at the time of levy of tax. Okay, thank you.